These are 7 stocks that are a buy right now. And the first stock is Marvell. The story behind Marvell is that it's riding the AI and data center wave, which data centers now make 72% of the sales. Furthermore, the Amazon chip deal could be on the horizon, which is something very bullish, and Marvell is just expanding its AI exposure, which is fueling its growth. The valuation at the moment is pretty cheap, with only a price to sales ratio of 10, while they have a lot of growth ahead. The forecasted revenue growth rate for 2026 is 40%, and for 2027 it's 20%. So yeah, there's still a lot of growth in this company. Now let's say a major deal goes through with one of these big hyperscalers, then their valuation is even cheaper than it's right now. And just remember, this company is making only $2 billion a year, which compared to NVIDIA is absolutely nothing, so they don't need to take massive market share from NVIDIA to get insane growth rates. There's something else that's very bullish for Marvell, and that is that the company reported 18 custom chips designs across more than 10 hyperscaler customers, which is up from just 4 a year ago, with 50 plus contract opportunities on the horizon, which is absolutely massive. Next up we got QXO. QXO is the largest publicly traded distributor of residential and commercial building products, including roofing, waterproofing, and complementary construction materials. And this is why the bullish case makes sense. Their powerful acquisition of Beacon Roofing Supply for $10.6 billion is a massive win and growth stimulator for the company. Furthermore, our analysts recommending that it's a strong buy with a price target of $32, which is a roughly 61% upside from current levels. The bullish price target is $44, which is a 120% increase from current levels, going from making around 10 million every quarter to 1.2 billion. The even more bullish point is that we are expecting rate cuts, and that is very bullish for housing sales, which has been dead for years. And what happens when you buy or want to sell a house? You will have to do a lot of work with constructors and materials, and this company is setting itself up to thrive in this environment. The third stock is another banger of a company, and that one is AMD. So AMD has a ton of potential the upcoming 3 years, and that is mainly because of the MI350 GPUs, which just started to roll out and is a major competitor to the NVIDIA Blackwell GPU, and that one will get a ton of demand from the data center side of the business. They got the best possible customers in the world, and those are OpenAI, Microsoft, Meta, all those big dog companies, and they're starting and increasingly deploying AMD systems in their data centers. There's also the Saudi Arabia $10 billion deal, which is also fueling growth, so analysts expect the data center side of the business to grow to $13 billion in 2028. That is a double up from what they're making right now. And that's not counting the other businesses that AMD has. But I honestly think that analysts are underestimating the growth potential of AMD. With China reopening, it offers a $3 billion additional upside. Furthermore, they have a great leadership right now with Lisa Su, which is very disciplined and continues to drive the execution of the company. But next year the MI400 will start to ramp, and they were talking about a 30x performance compared to the MI350, which is already a great competitor for NVIDIA. So there are a lot of positive things to talk about for the AMD stock, and it's a screaming buy, even after the recent stock price surge. The fourth stock is the Honest company, and I will tell you right now why you got to own this stock. In the recent quarter, they beat revenue expectation slightly, and they beat EPS expectation by 200%. Furthermore, they reaffirmed their expectation of 4 to 6% revenue growth for the entire year, which is a great guidance despite all the tariff drama, and they have a solid balance sheet. They have 70 million cash, so they have definitely room to invest. Wall Street is estimating that it's currently trading 40% below its fair value. The median price target is 7.2, which is an 80% upside. Furthermore, it's trading very cheap. The price to sales ratio is 1.1, which is absolutely nothing. And it remains the #1 brand for baby care products, with strong brand loyalty and expanding retail reach. And there are even more growth opportunities. They can do category expansion with new products and innovation, and they could even try to get in the skincare and household products. And expanding into international markets is another very big opportunity, and with their strong cash position, they could do a potential acquisition or partnership. And if growth starts to re-accelerate, it could demand a far higher PE ratio. The fifth stock is called UNH, the United Health Group. It's one of the biggest insurance healthcare stocks in America, and just this year this stock dropped 50%. Why am I bullish on the outlook of UNH? One of them is institutional confidence, also known as the Buffett effect. Just recently, the stock rallied 11 to 13% because Berkshire Hathaway disclosed a massive $1.6 $1.6 billion stake in the company, which is a clear signal of confidence from Warren Buffett and his team. And because of this, you can expect more upwards momentum. UNH is also expecting to grow 13%, and it has only a PE ratio of 13. With these growth rates, it can demand at least a 20 to 30 PE ratio. And there are a lot of growth opportunities to watch. Data, analytics, pharmacy, and healthcare services are high margin and fast growing areas. And the demographic trends of aging population that may provide better growth than expected. And under this new leadership, UNH can regain investors' trust, and on top of that, it's a dividend payer of basically 3%, which adds a defensive buffer during volatility. And it's always a great feeling to have Warren Buffett backing you up on this investment. I bought it right before he bought it, actually. Literally a day before him. Stock number 6 is Applied Optoelectronics, AAOI. This stock has insane growth and is projected to grow a ton more. And it's decently valued. The products are optical receivers, modules, and lasers, and they are critical for hyperscale AI and cloud data center infrastructure. And this is also a company that has one of the biggest hyperscalers behind them, like Microsoft, Oracle, and AWS. And they place themselves at the center of the next generation network demand. Apart from that, the recent inclusion in the Russell 3000 index improves visibility and liquidity of the company. And furthermore, this company has a price to sales ratio of only 3.5, while they're expecting to grow their revenue 80%. And they're expecting an EPS growth of 60%. So this stock is massively undervalued, and most analysts are expecting a 30 to 80% increase this year. And this company is very close to profitability. As you see over here, in the next 2 quarters, it will become profitable for the first time. And when that happens, it will get a lot more attention. Now, stock number 7 is FUBO. This one is pretty damn weird, because now there are multiple different bull cases for insane upwards potential. And the opportunity is especially now after the latest quarter result, which were pretty good, but nonetheless the stock price went down. And I will tell you now what the opportunities are. If the Disney deal goes through to the point where Disney will own 70% of FUBO, while FUBO will continue to do the management and continue to lead the business, that will have the option to make this stock boom, and which will cost Disney $220 million. Furthermore, it also brings significant financial support with $145 million in terms of loan, and this merge will make sure it becomes the second largest online pay TV provider, behind YouTube TV, with projected $6 billion revenue. And so the second thing is, in the latest quarter, FUBO exceeded both the subscriber and the revenue guidance, and it narrowed the losses to approximately $8 million, down from $26 million last year. So that's already a massive improvement by FUBO alone. And after the latest quarter beat, analysts upped their price target from $5 to $6, which is a 70% potential upside. And with innovative content strategy like including fast channels, regional sports, and potential new bundles, all this positions FUBO ahead of competitors. The other thing is that FUBO trades at a price to sales ratio of 0.8, which is extremely cheap, and it's expecting an earnings per share growth of 45%. And you can see over here, within the next 3 quarters, it expects to be profitable again. You can see that the revenue is expected to flatline, but if that Disney deal goes through, that revenue could skyrocket.